War is escalating. The Strait of Hormuz is effectively closed. Global markets are in absolute panic mode. So tell me, why are gold and silver crashing? If you are panic selling your precious metal right now because of a few red candles in early March 2026, congratulations, you are walking blindfolded into the dollar trap. You are playing checkers while institutional algorithms are playing 4D chess. Today, we are stripping away the retail delusion and decoding the undeniable mathematical truth behind this monetary shift. If you want to survive the next 6 months and catch the stage 3 explosion in hard asset, pay attention. Watch now. To understand the current market dislocation, we have to establish the dichotomy between the paper market panic and physical market reality. The consensus narrative is screaming that gold has lost its safe haven status. That is garbage. What you are witnessing is a textbook liquidity squeeze. Let's apply the dollar smile theory. This framework dictates that the US dollar strengthens at two absolute extremes, when the US economy is booming and when global fear triggers a violent flight to safety. We are currently staring down the barrel of the fear phase. With the Middle East blockade sending oil past $90 a barrel, Europe and Asia, who are entirely dependent on imported crude, are facing a manufacturing death spiral. Capital is violently fleeing the euro and the yen and hiding in the US dollar. The dollar index just shot up to the 99-ish level. So why sell gold? Because when institutional algorithms face margin calls on their illiquid over-leveraged garbage, they can't sell what they want to sell. They sell what they can sell. They liquidate highly liquid paper contracts of gold and silver to raise cash. They are shaking you out to balance their books. Stop looking at the daily spot price. It is a distraction. If you want to find the asymmetric return, you have to elevate your analysis to the underlying mechanics. The gravity pulling gold down right now isn't a lack of demand. It is the real yield equation. Let's do the math. Because of this asymmetric oil shock, the bond market has violently repriced Federal Reserve action. Just a week ago, retail was pricing in 60 basis points of rate cuts this year. Today, that dilution has plummeted to roughly 37 basis points. Higher for longer expectations are driving up nominal yields. Since physical gold and silver yield zero interest, they temporarily look mathematically less attractive to institutional capital. But here is the structural mode the consensus is entirely missing. This is exactly what happened back in 1973 and 1979. We are in stage 1 of a stage 3 cycle, and cost-push inflation is mathematically inevitable. Here is where we strip the delusion from the retail investor's mind. The crowd thinks the Fed is in control. The reality, the kingmakers are trapped. If they hike rates to fight this incoming oil-driven inflation, they crush the stock market and bankrupt the US Treasury debt servicing ability. If they cut rates to save a slowing economy, they let inflation run hot. Either way, fiat loses. Looking at the Yom Kippur War in 1973 and the Iranian Revolution in 1979, we see a distinct repeating pattern. The time decay, the lag between the initial geopolitical shock and the explosive rally in precious metal, is driven by the time it takes for high oil prices to physically bleed into the consumer price index, or in short CPI. In the 70s, it took 6 to 11 months for gold to go from a liquidity-driven crash to an absolute parabolic explosion. Thanks to modern algorithmic efficiency, 2026 moves faster. But physical supply chain do not. You cannot teleport freight. We are in stage 1 liquidity shock right now. You are looking at a 3 to 6 month time decay before $90 plus oil permanently raises the CPI floor. Do not let short-term red candles shake you out of a mathematically sound margin of safety. Sometime between May and July 2026, the Q2 earnings will reveal the devastating freight and energy costs. CPI will tick up. The Fed will be forced to pivot to save growth, accepting higher inflation. The moment they capitulate, the real yield will crash into deeply negative territory, and the stage 3 rotation into hard assets will be violent. Monitor the May CPI print and the 10-year Treasury yield. That is your radar. If you want to navigate this dislocation alongside investors who actually understand the math, hit subscribe, leave your biases at the door, and join the Deep Value Contrarian community. Buy and stay rational.